Hi, I'm Bart Basie. I'm a CPA and an attorney, and I've got a doctorate in accounting and business economics from Indiana University. You can put that together, and with about $3 or $4, you can get yourself a good cup of coffee. But having said that, I'm glad you're with me. The subject we're going to talk about now for the next hour is asset valuation. Extremely important subject for all tax return preparers in the United States. And you might say, Bart, why should I study asset valuation? I'm filing tax returns. Well, two reasons. There's tax forms that require that whatever the assets are that are changing hands via a gift or a sale have got to be filed and got to be reported. If you look at slide number 2, you're going to see that one form is a 706 form, and another one is a 709 form. And this provides a service to your client. It's very difficult if you find that a client comes in and says, well, I'm giving some of my stock in my company away, or I'm giving this art collection away, or I'm giving my antique guns to my grandson, and he wants to take a charitable deduction for it, or in some cases, he wants to take a charitable deduction for it. So you'll notice, for example, in the different bullet points I've got on the slide number 2, you can do it for business succession reasons, gift valuations, estate planning purposes. In a lot of cases, when a person passes away, it's very, very important to value the properties involved prior to filing an estate tax return, because you get what is called a stepped-up basis in a lot of these things. And that is critical. I'll stop just for a second to talk to you a little bit about what I mean by stepped-up basis in case you're not familiar with it with an estate tax return. When an estate tax return is filed and property is transferred, let's talk about land. The land might have cost the deceased person $100,000, just to pick a figure. You can take off zeros, you can add zeros. I want to give you the concept. However, when that property is transferred to an heir, the property is not necessarily transferred at the cost to the deceased. You need to value that asset, that property, and find out what the fair market value is at the time the deceased passed away. Let's say that that property is worth $170,000. It's gone up 70% from the time the deceased purchased it, acquired it, and the time the deceased passed away. And let's assume that the heir who's going to receive that property doesn't want it. They want to sell it. If you value that property at $170,000, which is the fair market value at the time the deceased died, and I'll talk about the valuation methods in a while. The key is if you valued it at $170,000, then the heir receives it at $170,000. That becomes the heir's basis. So when the heir sells it for $170,000, there's no income taxes, because he acquired it at a value of $170,000. He disposed of it at $170,000. Therefore, there's no income tax. There's no profit on the transaction. If you fail to properly value that asset, then what happens is you report it on the estate tax return at $100,000. The heir receives it then at $100,000 and has to pay taxes on a $70,000 profit. So this stepped-up basis means that all property, all assets transferred, for example, in an estate, can be valued at their fair market value at the day of death of the deceased, so the heir gets a stepped-up basis and pays no income taxes on that increase in basis. Now, you might ask me, you might say, well, wait a minute, Bart, isn't there an estate tax? Not necessarily. We're going to do a program, and hopefully you'll watch it, on estate taxes. And you're going to find that there's a gift and estate exemption, which is in excess of $5 million. Very few of your clients or mine might hit that level. And therefore, even though they will get a stepped-up basis and you'll file an estate tax return, there may be no estate taxes due. So you're saving not just estate taxes, but you're saving income taxes. So you might say, that's a key reason to understand any asset valuation that you have to place on these tax returns. Like I said, Form 706 or Form 709, depending upon the situation. Okay, that's that possibility of stepped-up basis. Very, very critical. And then it comes, obviously, the statute of limitations. If you can value something and the IRS, the Internal Revenue Service, does not question the valuation, and you're reasonable in your valuation, then there's no problem with it. Now, failure to properly follow the IRS guidelines on asset valuation can result in significant penalties, up to 50% of the extra taxes that are due by the taxpayer. That doesn't mean the taxpayer doesn't have to pay the extra taxes, but you as a tax return preparer can be hit with a penalty up to 50% of the additional taxes due. I have taught valuations for years at the university level. I've also lectured on valuations all over the United States. And unfortunately, I get involved in court cases as an expert witness on the proper asset valuation. You would be surprised how many people in this country hold themselves out and say, I know how to value something, I know how to have the asset valued, and they don't comply with the Internal Revenue Code, and therefore they run into major problems. I've recently involved in a situation, it's an unusual one, because a sale of a business already took place. The CPA firm that handled the sale of the business. Matter of fact, there are 18 CPAs in this law firm, in this accounting firm, and they've got 3 different locations. They failed to properly value the assets on the sale, and now there's a tremendous Internal Revenue Service question as to what the assets that were sold were worth versus, that's tangible assets, versus what the goodwill assets were valued at. And we're going to get into that a little bit. Remember, goodwill consists of 2 different elements: entity goodwill, the company goodwill, and personal goodwill. So it is amazing the problems that crop up when the people do not properly do an asset valuation for tax purposes. Let's go ahead and take a look at this program then and look at each one slowly and make sure we get it. I've given you an outline of some of the valuations of assets, and as I indicate, you know, in slide 3, the asset valuation, sometimes you might say it's relatively easy. You know, some items, if you got a car, for example, you can look at the Kelley Blue Book and get a wholesale price. There's home appraisals that are made, okay? Real estate appraisers that are certified to do home appraisals. Bank accounts, you know, we had a situation where I was called in. It was interesting. There's $20,000 in a bank account, and one appraiser said, well, it's only worth $10,000, and they went to court. And I'm sitting there on the witness stand, and the judge says, Mr. Basie, explain this to me. And I said, well, Your Honor, if there's $20,000 in the bank account, and I can close that bank account out today, and I can take the $20,000 out, I cannot understand how it can be valued at $10,000. There can't be a discount on cash. Okay, cash is cash. That's how we equivalent. We make everything an equivalent. Collectibles are another problem. I remember 2 elderly ladies in the state of Pennsylvania, and I went to talk to them, and we're doing an estate valuation for an estate tax return. And they were talking about how valuable all these collectibles were. And I said, ladies, I said, to you they may be valuable. To other people, they're junk. I said, you got to be very careful on your terminology, because once you start talking about this being a collectible, this being an antique, the value goes up, and then we have to value it differently than if we just sold it at a yard sale. So please be careful. Terminology is important. The second bullet point on this outline talks about business appraisals. This requires someone who's knowledgeable on valuing businesses. Matter of fact, the Internal Revenue Service says if you don't know about that industry, you shouldn't value that kind of business. I know in my firm, we value businesses all over the country in all kinds of industries, and we get called in by accountants and attorneys, CPAs and attorneys, to help value businesses, because unless you're aware of a particular area, an industry, you should not be involved in the valuation. There's where you have to rely on someone to assist you in that kind of. There's certain requirements that have to be met. There's methods that have to be done. And I've got some tax cases for you, and then unfortunately I'm going to show you what happens if you don't do it right, the penalties. And when you sign your name to a tax return, whether it's an income tax return or an estate tax return or a gift tax return, you can become personally liable if you haven't complied with the ethics requirements by the Internal Revenue Service that tell you you've got to take certain reasonable steps to protect yourself. And in today's society, My staff and I are very cautious in what we do, and we're very cautious in what we want to educate you on. Knowing that, let's see if we can't move on then and talk first about some valuation of assets. So take a look at slide number 4, if you would, and we'll talk about the valuation of assets that are reasonably known. So you don't need an expert. You'll notice I even put the word easy on the slide because I don't think this is a difficult situation. For example, okay, we talk about the Kelley Blue Book. Most people in the country are aware of it. And as a matter of fact, it's very cost effective because with the internet today and with Google, matter of fact, I'll inject one little comment. It's interesting. When my wife and I drive and something pops in my mind and I ask her a question, it used to be where occasionally, and I hard to say this in a program, but my wife used to be wrong once in a while. Today, when I ask a question, she's never wrong. And the reason she's never wrong is because she has Google. So be aware that the Kelley Blue Book, the internet availability that we have today is so easy that if you've got a truck or a car, that should be, by the way, cars, I'm sorry, I just caught a misspelling. It says cats, C-A-T-S, it should be C-A-R-S, cars. If you've got a car or a truck, I don't care how old it is or how new it is, you can find it on the internet. You can determine exactly what it's worth at any particular date and time, okay? And this is especially true if a donation of a vehicle is taking place. Recently, I was called by a lady in St. Louis, Missouri, and she said her husband had passed away, and they had 2 vehicles. One was a little Fiat a car, and she wanted to dispose of it. And I said, do you want to donate it? She says, oh, yes. I says, well, if we donate it, then we've got to determine the value of it. And it's very, very important that you receive objective information on the value. Do not take it upon yourself to arbitrarily determine a value. Oh my goodness, this car is fancy, it's nice. Please either get a used car dealership or a new car dealership, I don't care which, to write you a letter on the appraisal, or go onto the internet, find out exactly about the car, the odometer on the car, the condition of the car. They usually ask you if it's in poor, fair, average, good, or excellent condition. And determine that, and then do yourselves a favor, make sure you have a printed copy of whatever the appraisal is placed in your file so that if there's ever a question, especially on a donation, because the requirements on donating assets are more strict than selling assets, okay? There's also ways to do airplanes and boats and other vehicles, okay? It's not difficult to do it, but please take the proper steps to get documentation. I can't stress that enough of you. There's so many times when I've been called in to assist someone, the tax return preparer, and I say, okay, let me see your records. Recently, I was called in by a lady, who, not because she was a lady, but a woman who happened to be an accountant, not a CPA, and she was filing tax returns, and one of her clients had gotten audited. And she called me and she says, I've never had an audit of one of my clients. I don't know what to do. And I says, okay, take it easy. Let me see why they're auditing it, and let me see the files. And her reaction was, I don't have any files. I couldn't understand. What do you mean you don't have any files? I said, well, didn't the client give you any files? You filed the person's tax return. And she said, no. The client came in and talked to me. I wrote down what they told me, and I filed the tax return. I says, oh my goodness. I said, you've got to be very, very careful. That's absolute no-no in tax return preparation. She never received any information in writing to verify what the client told her, other than the W-2 forms that the client had received on a couple of jobs that person had taken during the year. And yet, tremendous amount of problem. As a matter of fact, her client was hit with a $110,000 tax bill, including penalties, interest, Social Security, the whole works. It just got way out of hand. And we were able to work with her and settle it, but I explained to her, don't ever file a tax return without having documentation to verify what you're doing, especially when you're valuing an asset, okay, that's going to be used in a tax return, whether it's being donated, whether it's being sold, okay? Let's see if we can't move on and talk about some other ones. Bank accounts. I told you about the situation of the $20,000 in the bank account. I mean, cash is cash. It's market value on the day of the cash. Now, this is also true for anything that can be easily converted into cash. Excuse me. So if we're talking about stock of a publicly held company, it is very easy to determine what the value was on a particular day. Again, get documentation. Whether you get a copy out of the Wall Street Journal or some other publication on what that stock was worth on that day. Or whether you contact the bank and say, what is the cash value on this day? Or like an insurance policy. What's the cash surrender value on a date? The insurance companies will give you that information. The agent will give it to you. The idea is you don't pick up the phone and just call them. You ask them to send you an email, and then you print the email out. That's your proof. It's on from their computer. It's from a third party. Or you ask them to send you a letter. Okay? Now, when you get into collectibles, item number E on slide number 5, it's a little bit more sensitive. Then you're talking about precious metals, antiques. Remember the word antiques. That automatically raises the value. Now, I know you and I may watch sometimes a TV show called Antiques Roadshow. I know my wife loves it. We watch it occasionally, and it's interesting because they're always showing some antique that the people are so surprised that the value is so high. Well, let me tell you something. The people wouldn't be taking their item to the show if they didn't think it was higher, and then they have to give permission to be on TV. So don't think they're that surprised. They know themselves that it's got to be worth more than what they paid for it. Otherwise, they wouldn't end up on television telling the world, oh my goodness, I paid $10 and it's worth $1,000. So antiques are very, very special. And I would strongly recommend when you get a value for an antique, you get it from a qualified antique dealer, and you've got to be careful of two things. First, you've got to make sure that the dealer has some kind of qualifications to value it, and then you've got to find out what kind of expenses would be involved to dispose of the antique, because a value may be $1,000, but then there might be a $200 charge to dispose of it. Therefore, the net value of only $800 is what you want to use on a tax return. Okay? Precious metals is something else. I have a client who deals in precious metals, and he considers himself an expert in determining what they're worth. And so he knows what he wants to pay for them, and he knows what he wants to sell them for. That's the type of person I would ask to assist if you've got clients who end up having precious metals that either want to sell them or want to donate them. So you're getting a little more sensitive when you get into valuing an asset that falls under the word of collectibles. Now, it's interesting because I just worked with an insurance company. I will not mention it because the insurance company is well known throughout the United States. However, they have a written document on what they consider as a collectible car. The question that came up was that there's a car 36 years old that has only, I think, 67,000 miles on it and is driven less than 2,000 miles a year. But the definition of a collectible car by this insurance company is a car that is not driven on the highways in the United States, that a car must be at least 30 years old and must only be used for shows. Well, that eliminates about 90% of what we consider collectible cars, because people who have collectible cars like on a beautiful summer day to drive them once in a while. To get 2,000 miles on a car, you don't drive it just to a show or have a truck to a show it and drive it back and haul it back. You might drive it. You might take it out on a Sunday for a drive. 2,000 miles is not many miles. But according to this insurance company, even though the car was 36 years old, even though it's considered one of the 250 most collectible cars in the world, according to a written document that was produced identifying this particular vehicle, the insurance company would not lower its insurance rates and give it a collectible antique kind of insurance rate, because their written definition did not fit, because the owner of that particular vehicle drove it occasionally around town for relax, even though the car has been shown at various shows. So again, be very, very careful when you get the precious metals, items, assets such as guns and antiques. Okay? Let's see if we can't move on just to give you a little bit more, because now we're going to get into businesses. Most of you and I deal with companies, clients of companies that are privately held, okay? And when we have privately held companies, the valuation of the stock of that company is totally different than valuing stock of a company that's publicly held, okay? This requires experts. This requires somebody who's qualified to do the appraisal. On behalf of your client, very important to get a written document. It's got to be signed and dated. And by the way, if any financing is or was being done by the SBA, the Small Business Administration, they require special aspects of evaluation if the assets are sold to a family member, regardless of the size of the loan. I remember in South Carolina, I got called. An individual was having an audit done because he had transferred some stock to his son. He actually transferred the entire business to his son so he could get a capital gain tax. Anyway, he transferred the business to his son. I'm just going to pick out some figures to give you an idea. Again, it's a concept. Let's say he transferred the business to his son for $3,000. And the business he had started for $100 years ago. So his son signed a note and said, "Dad, I'll pay you $3,000. Well, the father reported the sale of the business, reported $2,900 as profit, capital gains, and went on his way. The IRS decided to audit it because the transaction occurred between a father and a son. They did their own valuation of that business. And they came out with, let's say, $30,000 instead of $3,000. Tremendous amount of increase from what the father had done. Therefore, they considered the transfer fraudulent. They wanted to tax the father at the $30,000 because they said, you sold it for $3,000, therefore you gave a gift of $27,000. You didn't report it, you failed to report it. This is a major problem. I'm going to show you some problems and some requirements that you've got to be very careful with transfers between family members, okay? The SBA problem, requires even non-family transactions to have particular items. But in those cases, the transaction's got to be over $250,000. But if it's a family member, there's no limit. Matter of fact, one individual got in trouble just with a car, transferring a vehicle from a father to a daughter. The vehicle happened to be a Jaguar. Jaguar was worth over $90,000. Basically said the daughter could drive it and could have it and transferred the name into the daughter's name. That was a taxable gift. Again, while there may be an exclusion as to the amount of the gift that's taxable, the idea is that it requires a tax return to be filed. So when you're getting into business appraisals, we've got to be very, very careful. Work with someone who knows the industry. Make sure you get a written, signed document, and make sure that individual is aware of the SBA requirements, whether it's a family transaction or whether it's a non-family member. This affects gifts, this affects sales, and this affects estate planning when a person passes away, okay? Let's talk, and I'm going to spend a few minutes specifically going over some of these requirements. On slide number 7, I said, look, an appraiser, and we're talking about somebody who's qualified, okay? I know in my case, I've taught how to value businesses for 37 years at the university level. I've been teaching them the CPAs and attorneys with continuing education courses. I'm trying to educate you a little bit on the procedure so you'll understand what's going on. And when you do work with someone, you'll understand what they should do and you'll know the questions to ask, okay? These requirements come from two areas. They come from the tax code and they come from court cases, rulings, and regulations. For example, the IRS says, look, you can look at past projections to determine the future profits of a company, okay? And you can value a company based upon the historical record. Now, how many years do you go back? The maximum years you go back is 5 years, okay? We like to go back sometimes 3 years, 2 years, but you can't go back more than 5 years. And some appraisers, well, I'm going to go back 10 years because the business hasn't grown, it's been flat, and we can lower the value. Be very, very careful of that. 5 years is the maximum that you can go back. But the law does say you can go back. and look at past projections, past operations, and determine the future, and then you'd get a present value. Matter of fact, you've heard of this under slide number 7, I got B there. What's the fair market value of anything? It's what a willing buyer and a willing seller agree to, assuming they're both independent. So if a business is being sold to a third party, it's unrelated, and your client comes in and has a contract, the pressure's off of you. You don't have to go through a valuation because you've got an independent third party who wants to buy an asset. You've got an independent seller from the buyer that wants to sell. If they've negotiated an agreement and they have a written agreement that's fair market value, okay? And keep in mind what the definition says. Fair market value is defined, I'm going to read this slowly to you, make sure we understand it, as a price at which a business would change hands between a willing buyer and a willing seller. Look at the rest of it though, however, comma, neither being under a compulsion to buy or sell, and both having reasonable knowledge of all the relevant facts. Orlando, Florida. We had an individual who wanted to buy a company. When his attorney went in to look at the operation of the seller, they were very, very concerned that all of the relevant facts of operating the business and the potential liabilities were not being disclosed. They refused to buy the business on that basis. Okay? Or they lowered the value so drastically that the seller said, I'm not going to sell it. So please be careful. It's not just what a willing buyer and willing seller agree to. Neither have got to be in compulsion. So if a client is coming in and saying, I have to sell my business, or someone passes away and the heirs say, we don't want the business, it has to be sold, you've got to go through a valuation process, okay? So that there's no question about the compulsion to buy or sell the business. Let's now take a few minutes to look at some methods. There's several methods. The first 3 methods I'm going to identify are what we call a comparables price, a comparables approach, a capitalization of earnings, or an adjusted book value. Now, without making you certified valuation experts, because this 1-hour program is not designed for that, I want to at least give you some indication as to exactly what we've got. These are not the only 3 methods. There's actually a few more. Let me just show you all of them and I'll go back. We have the excess earnings capacity method, call it goodwill and I'll explain that, or present value of future income stream. So if you take a look at this A, B, C, D, E on slides 8 and 9, there's 5 different acceptable methods. All right, first rule. Should you and or the appraiser select one of the 5? The answer is no. I come across so many valuations of businesses that are done in some cases by certified public accountants, in some cases by law firms, where they will use only one method, which is A, the comparables method. Now, what is the comparables method? Not that it's a bad method, but the Internal Revenue Code says that one method alone does not tell you what a business is worth. You must use at least 2 or more. I'm going to give you the citation later on in the program, but I'm telling you at the front end, while there's 5 different methods, please, if you're getting involved in a valuation of a business for tax return purposes, make sure that of these 5 methods I'm identifying, at least 2 methods are used. Do not accept a valuation of only one method. So why do people use the comparables method? It's the easiest one available. There's different databases in the United States that are available that explain about transactions of privately held companies. Some databases deal only with small businesses, $500,000, $200,000 businesses. Some databases deal with businesses up to $20 or $30 million. And some businesses deal with very large transactions, all privately held companies. And essentially, I'm telling you there are 2 different ways of doing it. One, you can go to databases and get comparables based upon the revenue, based upon the industry. If they're selling widgets, find comparables that were sold in widgets. Recently, there's a grocery store was sold. We looked at grocery stores, found 31 grocery stores sold in the past year. And we're able to find out about the same size, about the same market share. Get it. The other way is by going into publicly held companies and taking a look at the price-earnings ratio of publicly held companies. Again, in the same industry, in the same sales level. The problem a lot of times with publicly held company comparables, as opposed to the database with privately held comparables, is that the publicly held comparables really are based upon future expected revenues. In other words, the publics that buy stock in publicly held companies are not necessarily basing them on what the company's worth today. They're basing and they're gambling on a future income stream. As a professor, one time I did a study that covered a whole slew of different publicly held companies, and we compared their stock prices when they made a forecast of what their profits were expected to be, and then their stock prices when they actually announced what their actual profits were for the same time period that the forecast was made, taking a look at what caused the stock price to go up or go down. And you would be amazed as to what causes stock market prices to fluctuate. Not just the economy, not just the presidential election, not just economics, but actually different factors of the business. If the CEO changes, if they sell certain operations, if they close some locations, there's a lot of different factors that go into it. And it's amazing. As a matter of fact, in one case, a company that made a forecast and was off the forecast by like 4%, there were so many sales of that stock that the stock market exchange handling that particular stock stopped trading on it for several hours that day when the announcement of the actual earnings were made. You may say, Bart, my goodness, what happened? Well, calling up a lot of people who were making sell orders, we found out that this company was so conservative, if they forecasted $1 and they only made 97 cents, the forecast, the people who bought their stock, assumed they were going to make $1.70 because they said this company was so conservative, we assumed that their forecast was also very conservative. So when they couldn't even hit their forecast, that meant that they failed to hit expectations of the buyers by a tremendous amount. So the comparables is an easy way to do it, but there's a lot of subjectivity to it as far as using the publicly held comparables. I would highly recommend using databases. But again, it's only one method. Let's take a look at the other ones. Capitalization of earnings. Here's what we do on this. Privately held companies have a problem. Privately held companies have a lot of benefits to the owners because they're privately held. They don't account to anyone. Okay? So there's different types of things. There's owners' benefits. There's unnecessary expenses that if you or I owned the company, we wouldn't spend the money on. It's not necessary to grow the company by spending the money. Okay? There's also expenses that maybe should be capitalized. Just recently, a week ago, I was called by a car dealer, and the car dealer could not meet the manufacturer's current ratio and debt-to-equity ratios. And I looked at it, and I talked to the accountant, and I says, let me ask you if there's any expenses that your boss has deducted that you're going to benefit over a year, or that you haven't even benefited yet, that you might have prepaid. And the answer was, oh yes, there's a lot of expenses that they deduct that really the benefit's going to come in 3-4 years. I said, well then, they don't have to be deducted. Well, all of a sudden, the loss of the car dealership turned into a profit. The ratios were met because an expense is really an asset that's been used. Within 4 or 5 hours, we were able to solve the problem by properly doing it. Now, here's the point I'm trying to make. When the second method is used, capitalization of earnings, you've got to go back, let's say 3 years, restructure the earnings for privately held companies by adding back unnecessary expenses, by adding back expenses that should have been capitalized, and by adding back owners' benefits that may not go on. Then you get a proper earnings or profit of the company. Once you do that, then you can project it. And since you can go back 5 years, you can project it for 5 years, not indefinitely. And then get a present value calculation. Okay, that's capitalization of earnings. Net adjusted book value, that's the easiest one to do. The adjusted book value is the easiest one because the adjusted book value method is simply going through all the assets on the books. As a matter of fact, here's what I tell people. And as a tax return preparer, I'm sure with your accounting background, you can understand this. I say when you have an asset on balance sheets, make a second column and a third column. On the second column, tell me what the fair market value is of all the assets on the books. And then I want you to add assets that are not on the books, that you have. For example, inventory. On average, people who sell inventory understate ending inventory by about 20%. And you and I both know by understanding any ending inventory, the cost of goods sold go up, which means the profit goes down, which means their taxes go down. When you're valuing the business, this is why we don't say book value. If you look at slide number 8, item number C, it says what? Adjusted book value. So you adjust it. So the third column would be the first column, which is the book value, plus the second column, or differential, into the third column. Now, as accountants know, the books have got to balance. How do you balance that with the liabilities and equity? Well, you subtract the liabilities, the difference is the equity, but it's not the book equity. So we always add an account for valuation purposes to the book equity called appraisal capital. Okay? Very simple. Call it appraisal capital. Let's try another method because this other